Hello, and welcome to this video on valuation using the dividend discount model. The dividend discount model is one of the classic ways to value a company's equity. As a shareholder in a company, you're going to receive dividends from that company if it's profitable, and that will be the cash flow that you as an investor receive. And as we've learned in previous topics, valuation is often based on present valuing cash flows. So, as a shareholder in a company, the cash flows you receive are the dividends the company paid to you. So let's value the company based on those expected dividends, that is, the expected cash flows you will receive as a shareholder. So this method is the basis for most valuation models. It's very heavily grounded in financial theory, where you are going to use net present value techniques based on our expectations of future dividends, and we'll be discounting them back to the present value using a cost of equity capital to value our equity. So dividends are returns to equity holders. So this is really important to remember as we go through the valuation models. This will make a little bit more sense. But the dividend discount model is going to value the equity of a firm. Other valuation methodologies will value the total assets of a firm. And remember your balance sheet, assets minus liabilities equals equity. So sometimes we're valuing the total asset value. Sometimes we're valuing the equity component of the business. The dividend discount model values the equity of a firm. And dividends are going to be discounted using the cost of equity capital, which in the formulas will have RE. Sometimes we'll have RF for cost of capital of the firm. Okay, so that's something to keep in mind for future valuation models. So what is the dividend discount model? Well, the dividend discount model is essentially applied using this formula. And what it does is it values a firm's equity. So V for value, E for equity. So this little subscript E is important, because it tells us we're valuing the equity of the firm, not the total assets of the firm. And the value of a firm's equity is going to be estimated based on the following. It's going to take the dividends for each year in the future that we are forecasting. So D1 means our expected or forecast dividend 1 year into the future. D2 would be the expected or forecast dividend 2 years into the future, and so on. And we'll divide that through by 1 plus RE stands for the cost of capital for equity. Okay, R is the cost of capital, E indicates it's the equity cost of capital, and we'll also have cost of capital for the total firm and a risk-free rate as well, cost of capital for debt. So we've got to make sure we use these little notations. RE means the cost of, to the power of 1, we're present valuing 1 time period. Then the second year's dividend will be discounted back by 1 plus cost of equity capital to the power of 2, which is present valuing 2 periods back. Okay, and so on each year into the future. So we've got these 7 steps we have to follow to value a company using the dividend discount model. First, we forecast net dividends up to a forecast horizon. In previous topics, we've learned how to do forecasting. So step 1, forecasting the dividends, we would take these dividend payments straight from our forecasting template that we've already completed. So step 1, you'll have done when you've done your forecasting. Step 2, estimate the cost of capital for equity, which is this RE term. We're going to talk about that in future topics. So we'll learn how there's different ways of estimating the cost of equity capital. For our purposes today, I'll give you cost of equity capitals if you're going to do a valuation question, or you could just choose a number like 8% or 10% just to get started. You then discount future dividends to the present value. This means each of these terms here, the dividend divided through by 1 plus the cost of capital to the power of t, this is doing the net present value formula. So step 3, discounting the future dividends. We've got our dividend forecast, then dividing through by this term is creating the present value or the present value calculation or the discounting. Step 4, forecast the dividend growth patterns beyond the forecast horizon. So let's say we've done our forecast template for 5 years. So we've got dividends 1, 2, 3, 4, and 5. Then at some point in the future, because we know companies can last forever, we're going to have to estimate what the company is going to do for those future years. So we may have forecast dividends for 3 years here, 1, 2, and 3. Then I need to think about what's going to happen after that. So I'm going to forecast a growth pattern such as maybe I think the dividend will grow by 3% per year forever after. I can then calculate what's called a terminal value or TV, which I'm going to use here. And I'll then also discount that terminal value back to the present value. And I'll add up each of these terms, the discounted dividends for every year, plus the discounted terminal value to get a total equity value. So I'm going to talk more about the terminal value as well now, just to explain that concept in more detail. So to recap, the dividend discount model, we've got our formula here. The first thing you need to realize is you need to get all the different terms for the formula before you can estimate it. When I've got D1, D2, D3, etc., they're the forecast dividends for each year. And you'll get that straight from your forecast template that we've already talked about previously. The denominator of the formula, this would be called our discount factor, or this is where we apply the present value approach to the dividend. So each year the forecast dividend is divided by the discount factor, which is 1 plus our cost of equity capital to the power of t. And this is doing the present value calculation. And we always remember the terminal value that we have to calculate. That needs to be present valued as well. So that needs to be brought back to time zero with a present value calculation. So let's talk more about the terminal value, because this is really the difficult part of the dividend discount model. We know that companies may last forever, but when we do our forecasting template, we don't try and forecast hundreds of years into the future because we know we're going to be very inaccurate and it would be too difficult to do. Cost-benefit analysis, it's not worth our time to try and do detailed forecasts 50 or 100 years into the future. So we need to have some sort of finite forecast horizon which we've put our time and effort into, and then after that we'll have a terminal year or a terminal value year, and we need to calculate what's called the terminal value. And to do that we're going to have to make some simplifying assumptions. And essentially there's 3 ways we can do this. We can assume a terminal value could be equal to 0. So I've forecast my dividends for 5 years, and then in year 6, I assume there'll be no more dividends. I think the company's going bankrupt, or it's making losses and it'll never pay a dividend again. Maybe it's a finite life company, like a mining company. They've done their mining, they've completed their project, and no more dividends. The second option, the second assumption could be there's going to be a perpetuity. So I think in year 5, my dividend will be $2 per share. And I think every year after that in the future, they'll continue to pay a $2 per share dividend. The company will continue operating, it will continue being successful, but it's not necessarily going to grow. And the third option is that the terminal value will have growth. So in the 5th year, my dividend is $2, but I think it's going to go up by 5%. So the next year it'll be $2.10. And the next year it will grow by 5% again, and it will keep growing by 5% a year forever. Okay, so they're the sort of assumptions we can make. They each have reasons why we would make them or wouldn't make them. And when we apply the dividend discount model, we have to think about which one's most likely for the company we're trying to value. So mathematically, here's what it looks like. We've got our 3 assumptions. Terminal value is equal to 0. I would put 0 here in this term. Then present valuing 0 is going to give us 0. And that would be when we expect no more dividends to be paid. Okay? Like the mining company that is going to mine gold for 5 years and there'll be no more gold left in the ground, so they're not going to pay us any more dividends. Or the company we expect to go bankrupt in a few years' time, no more dividends then. The next option, terminal value, we would expect the dividend at time t, we would divide through by RE. So this terminal value, TV, would be equal to our dividend in the terminal year, and would just divide through by the cost of equity capital. So we could have, say, a $2 dividend divided by 0.10 if our cost of equity capital was 10%. And that will be called an annuity. The calculation would be called an annuity. So we'll get a number which would be our terminal value. We then discount it back. The third one is if the terminal value has growth. So we've got our dividend in our terminal year. We expect it to keep growing by a certain percentage each year. So we'd multiply it by 1 plus whatever the growth rate is, say 5%. So if our dividend was $2, we'd multiply it by 1 plus 0.05. Okay, we then get our dividend for the following year would be $2.10. We then divide it through by the cost of equity capital minus that 5% growth rate. And that will give our terminal value. So if we compare these, 0 is going to be the smallest number. It's going to give us the lowest value for the company. The terminal value with growth is going to give us the highest valuation of our company. And this terminal value in perpetuity will be somewhere in between the 3 options. When we're assuming growth in the terminal value, we have to be conservative. Companies can't grow their dividends by 10% each year forever, because at some point they're going to be growing larger than the whole global GDP. So when we're doing our terminal value assumptions with growth, a couple of percent might be okay. But for hundreds of years, companies can't grow faster than the overall economic growth rate. That's too difficult to pull off in the long run. So we need to remember to be reasonably conservative with our long term. So just expressing the terminal values in a different way. If we're doing our net present values for the cash flows in period 1, 2, and T, which is our final year. If our terminal value is 0, we don't have a terminal value here. It's just not in it. The second case, a terminal value with perpetuity, which is the same number, the same dividend or cash flow would be paid each year. We've got X1, X2, XT. Then XT, which would be our final cash flow, we divide through by our cost of equity. Okay, that's an annuity calculation. And would then have to discount it back doing the terminal value calculation. The final way of doing it, with growth, we've got our final dividend in period XT times 1 plus the growth rate. And we divide through by our cost of equity capital minus the growth rate. And then we do the present value calculation as well. And here he says, note the cost of equity capital must be larger than G. If you're forecasting growth in perpetuity, it has to be less than the cost of equity capital. A business can't grow forever faster than its cost of equity. That's too good to be true. And it also breaks the maths down. It makes it not work. So, in conclusion, the dividend discount model, DDM, it is a very common valuation methodology. It's an appealing concept because dividends are the cash flows that shareholders receive. So when we're valuing a bond, we value the cash flows that the investor receives. When we're valuing a company, we think about it in the same way. We're going to value the company based on the cash flows the equity holder receives, which are the dividends. However, there are some theoretical problems with this valuation model. Dividends are distributions of value. They're not necessarily linked to the creation of value. So I could be running a company that is making a loss this year, but I can still pay a dividend if I've got retained earnings from prior years. So my dividend this year may not be linked to any value created this year. If you've studied finance, there's these two finance scholars who sort of created the field of finance, Modigliani and Miller, and they have a theory that states dividend policy is irrelevant to valuation. If I'm an investor in a company, if I want to receive cash flows from that company, the company doesn't need to pay me a dividend. I can just sell part of my shareholdings and liquidate it. So a company giving me dividends is the same as me just selling a percentage of my shareholding in that company. So there's actually no valuation effect from a dividend payment according to Modigliani and Miller's theory. Dividend policy can be very arbitrary. The board of directors get to choose if a dividend's paid, how much that dividend is, when it's paid. It doesn't have to be linked to the profitability or the operational value creation of the firm. Some companies will borrow money from the bank to pay dividends, so that's not necessarily showing value creation for the firm. And in a practical sense, the valuation is really sensitive to the forecast horizon and the growth assumption used. When you build a dividend discount model, play around with the terminal value assumptions you put in there, and you'll see that the model's very sensitive to if you put a growth rate or not, or if you put a growth rate of 3% or 5%. The valuation you get will change a lot. By definition, the hardest thing to forecast is going to be the furthest into the future. I'm going to be much more accurate forecasting 1 or 2 years into the future than I am forecasting 10 or 20 years into the future. And the terminal value assumption is forecasting essentially 10 or 20 years in the future, and that's the part of the valuation model that is most sensitive. So the hardest numbers to forecast are what's making the valuation most sensitive. So it's a little bit of a problem practically there. Additionally, some companies just don't pay dividends for a long time, and trying to predict when they are going to pay dividends is really a problem. Okay, so dividend discount model is popular. It's useful for about 30% of companies on the stock market which are mature and pay reasonably predictable, sustainable dividends, but it's not so great for those young growth companies that are, whatever money they're generating, they're investing back into their company and they're not paying dividends. Okay, so we have to know when it's appropriate to apply this model.